The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady from EG Tax, and I'm wishing you a happy tax season. And I'm joined in studio with Chris Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher and Tiffany Fabian.
Hey there. Ready for the tax season?
I am ready. When I was here with Mike, the last show we were on, with the financial guys, and he says, "Why are you dressed up?" I said, "Mike, I work for a living, you know." Because during the off season we come pretty scruffy.
Yeah, exactly.
You know.
Precisely. So
Right.
I'm excited. I will be sleeping less, but this goes with the territory, and so you just plow through.
Oh, for sure. And
I love helping
so
people.
It's so wonderful to see your clients that you saw last year, the year before, you know, year after year. And we certainly want to be your advocate. That's our goal. We're not perfect. We wish we were. We strive for perfection, right? We certainly are in your corner. And again, when do our offices open, Mr. Chris?
Well, they are open right now. Our offices are open till 5 today, then Monday through Friday next week, 10 to 7, and Saturday then 9 to 5, and then the following Monday we are there 9 to 9.
Right, at least.
At least.
Again, our phone number here in studio is 8030930, 8030930. Start 9:30 on a cell phone. You can text us at 3930. And now the other thing is the IRS is kind of not open for business, right?
No, not yet.
They will be on the
27th.
27th. And people, like, we were doing tax returns all day today, and what we do is we send them off, and they kind of sneak us in a little earlier, don't they?
A little. They do
like
have
3
to do
days, 3 days.
Yeah, they
early.
have to do testing with the IRS, our software company. So they take a couple here and there, and they send them early. So some people may get some nice surprises, you know, because they got their money faster than they thought. But
I
we
will
can't
tell you,
say
if you got an EIC, they're holding them up till when?
February 15th.
Yep.
Right.
Yep. And
So the earned income credit is for people that have wages, that have a qualifying individual living in their home. Usually it's a minor child, but it could be a relative, the disabled relative, or a minor relative that's you have custody of. Or if you're between the ages of 25 and 65 with lower income, they actually give you money back that you didn't pay in.
That's right.
Right.
And not only does the federal do that,
New York State
New York State does it as well.
Which is pretty cool.
Right? So that's something where they're holding those up till February the 15th. The other thing is, I was telling a client this morning that they're promising that if you did get an earned income credit, that they're going to make sure that they kind of audit you in the summer to prove that the person that you had, the qualifying individual, actually qualified to be in your house, and they're going to ask for proof of that. So it's really important that you're ready to prove that deduction if they should contact you in the summer.
I was eavesdropping on you today. There's a person who couldn't claim their child, but they're the custodial parent, and you said, well, you get to still claim earned income credit,
Right.
even though you don't get to claim that child.
Right.
And so that's really a big deal.
As long as the child lived with her.
Yep.
Right?
Yep.
Okay, I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone. Some of the things that we think that you guys should be aware of is even though there is no penalty for Obamacare,
Right.
that doesn't mean you should just kind of flip by that form that they're going to be sending you if you got health insurance through the marketplace, right?
That's right.
Because why?
Because you still have to do the reconciliation if they were giving you a subsidy for your health insurance. So if it was supposed to be $1,000 a month and you're only paying $200 based upon your income, you have to reconcile to make sure that that $200 is correct. Because if they should have been giving you $850, and which means you should have been only paying $150, you're going to get money back. But if you should have been paying $400, then you're going to owe an extra $2,400.
Okay, so let's say that it was timed for enrollment at the beginning of 2019, and you weren't working, and you said you got online and said, I need the health insurance, and you put, well, I think my income's going to be $5,000 because I think I'm only going to get unemployment. All right. But then in February, you get this gigantic job making $70,000 a year, and you still have your $500 subsidy every month. You're paying in to your health insurance, basically being subsidized by the federal government and the state of New York. So at the end of the year, they send you this form that says, "Wait a minute, Esther. This is how much we gave you for your health insurance. Now let's take a look at your tax return. Oh, you made $70,000. You owe back that whole $500 times 12 months, which is $6,000. So you don't get a refund. You owe us $6,000. And that's what's so important about the subsidy.
Yep, exactly.
And then I was helping a client yesterday, and she makes about $27,000. She spends $400 a month for health insurance, and she would qualify for the essential plan, which is about $20 a month. So I had her talk to Tim, who's our healthcare navigator, and he's going to sign her up for the the essential
Which would
plan.
save her a ton of money.
Save her a ton of money.
And that's, this whole health, even though Obamacare kind of is dead, in New York State, it's alive and well because the state of New York really wanted to make sure that its residents that are lower income got all kinds of benefits. And so those things are in there. And so if you're paying a whole bunch of money in health insurance and you're somebody that's really under the gun, you think you can't afford it, so you didn't get it, or you are, thinking, oh, should I pay this insurance or eat? I mean, that kind of situation. Give Tim Eliason, he's the president of EG Health Connect. You'd be surprised what's available to you out there if you ask. If you just want to overpay, there's nothing I can do to help you.
Right.
Want the text question? It says, Esther, I married a Canadian who does not live here or work in the United States. This year, the 2019, how do I file my income tax return if she does not have a taxpayer ID or social security number?
Okay, so where do you live is the question.
Well,
right?
if you're a U.S. citizen and you're living here, or rather you're a U.S. citizen, you're living in Canada, you're going to have to file a 1040.
Apply for.
The question is, do you want to file joint or you want to do married filing separate? The easiest way would be to do married filing separate because this way you don't have to show her income on the tax return. If you do want to file joint, you put her income on, and then you get a credit on the U.S. side for the taxes that she paid in Canada. So it would help to offset the taxes.
And she can apply for a taxpayer identification number.
Yep, doing a W-7.
Right. So there's a way around it. And if you need help, you can go to our website at egtax.com, ask the tax lady, and I'll kind of point you in the right direction. By the way, a lot of people that have questions, if you call our offices and we're busy helping people with tax returns, obviously they would take precedence. But if you go to our website and email me, I answer the questions all the time. There's no question that I can think of that's ever been asked that I didn't answer. So again, if you're not getting your questions answered at our branch office or through a corporate, and usually we're able to help most people, just go to our website and I'll make sure that I help you.
This makes me sound like I did a tax return last year for a U.S. citizen who married a Canadian lady in China, and so we did the return as joint, and we had to apply for a tax ID number. So that's maybe what this person's going to do.
Well, and that's true. And the other thing is, for any Americans that have income in a foreign country, and believe it or not, Canada's a foreign country, and you have more than $10,000 in a foreign bank account or foreign investments, you have to do an FBAR return, which is not a tax return, but it's a financial disclosure form with severe penalties, like up to $10,000, if you don't file the return. So that's another thing that our texter might want to look at. I know we got phone calls. We got to take a short break. Tom, Dorothy, and your calls on the other side. We're going to break for a minute. We'll be right back. Hey, that's kind of our stolen theme song. We are family. We think of you as family. And And so when you go to EG Tax, by the way, if you have any complaints, anything that you please let us know, because we want to help you. We do everything but cheat, I want to tell you.
Yep.
We want to do what's right. And so please, we invite your feedback. And we got callers who are waiting. We're going to go to Tom, who's waited so long. Hey, Tom, how can we help you, sir?
Yes. I just turned 65 in September,
Okay.
and I was told that I wouldn't be eligible for the earned income credit. Is that true?
That's correct. In the year, you have to be between the ages of 25 and 65. In the year you turn 65, you
Unless
become
you have
disqualified.
qualifying
unless,
children.
unless you have children at home.
No.
Yeah, this would be, so there's the earned income credit with qualified individuals, and then there's the earned income credit for people between the ages of 25 and 65. Once you hit 65, you're eliminated. So,
Okay.
but what you did get was a larger standard deduction, so that's a good thing.
Okay.
And you can.
What is the standard deduction?
Well, the standard deduction this year is 24.4, and once you're 65, are you married or single?
I'm single.
All right, so you get an extra $1,650.
So you're at 12.2 plus.
Oh,
six-
yeah, that's right. You're single, so you're 12.2 plus $1,650.
Okay.
Okay.
Okay. Thank
All right. Thanks, Tom, for waiting.
you. Okay. Bye.
Bye bye. Okay, and we are going right to Dorothy. Hey, Dorothy, how are you, my dear?
Okay, thank you so much, Esther, for taking my call.
Yeah. What can we do for you?
Well, this is going to be my first year to do a requirement minimum distribution for myself. I'll be 70 and a half. I guess I
Wait, Dorothy. You might be one of the lucky ones. When do you turn 70 and a half?
of November 26th.
Of next year, of this year,
This
right?
year.
Okay, so they just changed the law 5 days before tax season, before Christmas, excuse me, and you no longer have to take your RMD till you're 72.
Wonderful. Okay, well, that's great. Okay, well, that will settle that.
Postpone. We'll talk to you in 2 years.
Now, but
Now you
now,
could
Dorothy,
take
do
it.
you have any other source of income?
Yes, I do.
All right, so you have like a pension plan and things of that nature,
Pension and
and Social Security.
so I'm okay right now, no problem.
Well, let me ask you this though:
Okay.
not counting your how much is your pension a month?
My pension money coming in is about $500 or so between.
Around $6,000, right?
Yes.
Okay, and your Social Security is how much?
My Social Security is about, I think it's 21,000 or so per year.
And you're single or married?
Married.
Okay, so your husband also has a pension?
Yes.
And how much is his pension?
Yeah. His pension's about $2,700 a year or so.
2,700 or 1,000?
A year. 2,700
All right, so your
A month or a year?
year. For,
All right, so your pensions are around 6,700 and the rest is Social Security, right?
Right.
Okay, so really your standard deduction is 24.4 plus 2,600. So about $28,000 before any of it's taxable. What you and your husband might want to do is, even though you might not
required.
have to do the RMD, you might want to do the RMD because you probably have some money out there hanging that's not going to be taxable at all, and you can start taking money out to that limit on your RMD and not pay any taxes at all. But if you want to call us, we'll work those numbers out for you.
Which is a pretty cool tool.
Okay?
Is that advisable to take it out from a regular IRA?
Yeah, so here's the thing. If you and your husband's Social Security is 40, all right? So that's 20 plus your pensions of 7, so that's 27,000. And so 32,000 is the floor. So you're under by $5,000. So none of your Social Security is going to be taxable. So it looks like you'd be able to take out around
I'd say about
$5,000 or $6,000 tax free.
Yeah, but even still, even if it makes some of her taxable Social Security, their income won't be high enough with their standard
Right, that's true.
deduction. So you probably could easily take $10,000 out a year.
And so the thing
Pay
is,
no
you're
taxes.
skinning the cat. You know, so many people say, "Oh, I want to do a Roth IRA because it'll never be taxed." Well, that's great. In essence, you can make your own Roth IRA because when you take it out, we'd have to do the exact figures, but let's say $10,000 you can take out of your IRA tax free. Then just put it in your bank account, put it in your investment, and you've already paid taxes on it. So in the event of your death, your kids inherit it tax free.
They don't have to pay any taxes.
Right.
Okay.
So give us a jingle, Dorothy.
If that's a lot to wrap your mind around
Right.
right now, we'll break it down for you.
In other words, it's good.
Okay.
Okay?
There would be no tax between my husband's and my.
That's exactly right. Because even though you have substantial Social Security,
Right.
it's going to be tax free. So, okay?
Thank you so much.
Thank you, dear. Bye-bye. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 3930. And I'm going to go back to Kevin. Hey, Kev, how can we help you, sir?
Oh, you speaking with me?
I am. If you're Kevin, I'm Esther.
Yes, ma'am. Hi, Esther. How are you?
Good. What can we do for you?
So I guess my question is this, and I'm really not quite sure where to go with it. I have a fiance. We're both the same age. I provide the income pretty much for our household. However, she did work this year. Again, we're not married. She's just my fiance. I have a child, which was with somebody else.
Mm-hmm.
And so obviously I claim him every year, and I get the earned income credit.
Does he live with you?
Yes, I
Okay.
have full custody of him.
Okay.
And so we also have a daughter, Kimberly Elizabeth. She's about 20, 21 months old. She's a beautiful little girl. So now, would she be able to claim her and get the earned income credit?
All right. So let's back it off. So you are a single taxpayer with a child that lives in your home, correct? And the lady that lives with you is not married to you.
Correct.
You have two children, one from another relationship that lives with you, another with your fiance.
Yes, ma'am.
That is your child, correct? The baby is your child.
Yes.
Okay. So for sure you're head of the household, and you definitely can claim the your
first child.
first child. The second child now would be
You'd have to see
Whose income was higher.
right.
right who gets the better result for earned income
One
credit.
of you in the household or head of household, and one of you are single.
Right. So your fiance is going to be single, and who decides who's going to claim that child would be depending upon what's best for the household. Now, how much does your fiance make in wages?
She only made about $8,000 last year.
Well, she would get the earned income credit for sure.
And how much did you make?
A little over 50.
Oh, so really, there is no earned income credit for him
No,
at 50.
not at all.
So
You'll get the child tax
she
credit
would
for your
do
son.
she would do single and get the earned income credit.
Right.
Right. So she'd be single with the earned income, provided that there's no friction between the two of you. Okay. Because
Oh, no.
no, in other words, you have if push came to shove, and you wanted to claim the child, you would be the person that would claim the child. You'd be the steering person. It's called the tiebreaker. The person with the higher income would be the person that would get the exemption.
But you, again, to reiterate, you both can't claim head of household.
Right.
One of you will claim head of household. One will do single.
That's exactly right.
Okay.
Okay.
Yep, that sounds good.
All right. Thanks, Kevin.
Yes, ma'am. Thank you.
Bye bye.
And that's why taxes get so confusing. I mean,
Well,
situations
especially,
like this occur all
You know,
the time.
it used to be that you had the mommy and the daddy who had the two children. They lived together no matter what, and it was kind of simple. But now we have a more flexible, progressive society, and there's multiple relationships and multiple kids and da-da-da-da-da, and so it makes it more difficult.
It does.
Right? And so the IRS basically says if in that situation where where the parents are living together, the person with the higher income, if he were to push came to shove, he would win. He would claim the child, and she would not get the earned income credit. So, all right, let's see, Mary. We're going to go back to the phones and talk to Mary from Buffalo. Hi, Mary.
Hi, Esther. Thanks for taking my call.
What can we do for you?
I want to follow up on what you were just talking about with the IRAs and Social Security. just want to be sure I
Sure.
understand. If somebody has contributed through their working life to a traditional IRA, not a Roth,
Right,
so the traditional where they have not paid taxes on it,
right.
and so it builds up, and then they retire.
Right.
And if they take money, whatever, let's say this year you said the standard deduction is 24, I think.
Well, how old are you?
It doesn't apply to me. I'm just trying.
Okay, it's 24.4. If they're over the age of 65, it's an additional 2,600. It's 1,300 apiece.
Well, let's go with the whatever 24.4. So let's say take out 14,000 from that from the traditional IRA.
Okay.
Are you saying that is not taxable?
Okay, I'm not saying that that's not taxable. I'm saying that in this situation, when somebody has Social Security and a small pension, the only thing that's going to be taxed is the small pension, which leaves them room because of the high standard deduction before they could have other forms of taxable income before they'd pay taxes. So in this situation, they can kind of create their own withdrawal and take X amount of dollars out using that standard deduction to cover the taxable income, and then it would be tax-free.
Each person is individual and unique.
Right. And so you have to go through all the numbers to see how it works, but it's a way to skin a cat. Okay?
Thank you so much.
All right, bye-bye. I'm Esther Golias, the tax lady. We're going to take a short break for the news. We'll be on the other side. Hey, we are family. I'm Esther Golias, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone, and you can text us at 3930. We're talking taxes. This is the first week of all of our offices being open. Things are going to start rolling in. Of course, the IRS is not open for business officially till the 27th of January. If you have an earned income credit, you're not going to be looking at your refund till the middle of February because they're scrutinizing those. And they're promising to audit people with the earned income credit this summer. So make sure that you have all that documentation in place. And should you get letters, we're preparing our clients so that boom, we can help them.
Right, and it was Mary who just called. Right, was the last caller.
Yeah.
Just I don't want to seem like we rushed her off the phone. Each person is unique, and you can't just say, "Oh, we said $8,000," and you can take out and it's tax free. You got to look at the whole picture for every single tax return. It's going to be different.
Let me give you an example. Let's just say that a single person has $10,000 in Social Security. All right, just a single person over 65, and his Social Security is going to be tax free.
Yep.
His standard deduction is 12,200 plus 16, so about $14,000. So this guy could take out like $12,000 and not pay taxes out of his IRA because of the large standard deduction. And so the game changed when they eliminated the personal exemption, but they increased the standard deduction. You can use that to kind of say, well, it's true that the Roth IRA is taxable, but I have such a large standard deduction, I'm not going to pay any taxes on it.
Right. That's absolutely right.
Okay, let's go. We're going to go back to the phones again, but I also wanted to talk about if you turn 70 and a half in 2020, you don't have to take your RMD until you're age 72 unless you want to, and that's
correct.
What we're talking about.
And that was that caller. Yep.
Right? And we talked about that. And the other thing is, don't ignore itemizing. You may not make it on the federal, but New York State has not changed the tax law to follow suit with the federal, so they're using 2017 tax law.
Right.
And so you may not be able to itemize on the federal, but those things that aren't deductible on the federal are deductible on New York State, so you actually end up doing a tax return with the federal using federal law and your tax return on the state
and
using
then don't forget
they
just extended a few days before the close of the year that you can deduct mortgage interest, and it's retroactive. It goes back to 18.
Right.
So
that's
PMI. Correct.
When they
Mortgage
changed
insurance.
the law 5 days before Christmas, there was the 70 and a half rule for the RMDs. There was people that are working that are over age 70 and a half. They couldn't put money into an IRA. They now can. You can still do a spousal IRA after age 70 and a half. And you can now, if you had the MIP,
Mortgage
or is it
insurance.
PMI, MIP, PMI?
Same thing.
That wasn't deductible in 18. It's now deductible in 18 again, even though 18 passed. You can amend your return and get that
Yep.
money back, and you'd
19.
also get your money back for the tuition and fees.
That's right, which is an adjustment to income. And there's many people who had the lifetime learning potentially, but their income was too high and it was phased out. So the adjustment to income for the tuition and fees might have been the answer for them, which would have affected the federal and the
That's
state.
exactly right. So that's back on. Well, that would have been deductible on the state anyway, right? Because the
Yep.
state,
Yeah.
the state followed suit.
That's right.
But you certainly can amend the federal.
Yep, you certainly can.
And the other thing is that just changed. If you just had a baby in 2020, or you're going to have a baby in 2020, you can take $5,000 out of your IRA or 401k. And if you're under the age of 59 and a half, you would have had to pay a 10% penalty. You can take up to $5,000 and not pay taxes. And the other cool thing on a 529
is you can use it for student loans.
That's
now,
right.
Up to $10,000.
People with student loans, they say, I don't know how to get out of student loan debt. You can now take the money out of your 529 to pay up to $10,000 on your student loan debt.
That is
Tax-free.
cool. Just a tool in their toolbox.
Tool
which
in
is-
your toolbox.
So many people have huge student loans, and it's just a great way to circumvent
It's
that.
a way. I mean, I know people are just up their eyeballs and alligators. They don't know what to do with their student loan debt. But this is a way to have it deductible on the state, and you get and it's tax-free on the federal.
Right.
I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. And we're going to go to Bob in Clarence. Hi, Bob.
How you doing today?
Good. What can we do for you?
My wife was the executor of her aunt's will, who passed away in June of 19. Is my wife required to file a tax return on her behalf?
Well, it all depends. Did the aunt have income? Did the aunt's estate have income?
She had income. She worked up until the time she passed part-time.
So, yes.
All right, so she will file a tax return, her final return for her aunt. That'll be on a 1040 up to the date of the aunt's death. Then after the date of the aunt's death, were there assets that were making money?
Yes, there was IRAs.
Okay, so what happened with those IRAs?
They were distributed to her two sons, which she requested.
Okay, and were they beneficiaries, or did the estate
Yes.
distribute?
No, they were beneficiaries.
All right, so there was nothing else besides that.
No.
Then you wouldn't have to do a fiduciary. You just do the 1040.
So you do have to do an individual return for the
Right,
aunt.
and if there's a refund, then that refund is going to come back to the estate, and then she'll distribute that.
You have to do a 1310 form, release of refund to the person who's in charge of the estate.
Right, and which would be your wife.
Correct.
Okay, Bob?
Thank you very much.
You're welcome, sir. Thanks for calling. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And we got John. Hey, Mr. John, how can we help you, sir?
Good afternoon. How you doing?
Well, you have a deep voice, John.
What I'm calling about is I have a teenager that had worked in the previous year,
Uh-huh.
and he made approximately $2,200.
Uh-huh.
Does he have to file?
Okay. So how old is he, did you say?
17.
17?
Yep.
Okay. Is this your child?
Yeah.
Okay. So he doesn't have to file, but he wants to file because they probably took federal taxes and New York state taxes out of his paycheck. And he's not going to get the FICA back or the Medicare back, but he is going to get the federal and state withholding. So he wants to file to get his money.
All right. What form would you use for that?
He's going to file a 1040.
And he's going to indicate that he's a dependent on,
your
return.
Right.
I'm sorry, say that again.
It's a 1040, and on the 1040, he's going to indicate that he's a dependent on your return.
So he's not going to claim. He's not going to list. He's basically saying to the IRS, I'm filing a return to get my refund back because I'm being claimed on my dad's return. That's what the IRS talks in tax forms. That's what the form's going to say, and then you get to claim him on your return, and you're going to get a $500 credit for him.
Okay.
Okay?
Yep. Thank you very much.
Thank you, sir.
That's
Bye-bye.
a really good question.
Yep.
Yeah.
And it happens all the time. How many times do we see, I'll have the parents in my office and they'll say, oh, yeah, Paul got a job this year. He's working at Delta Sonic. Oh, that's great. Are we doing his return? Nah, he only made $4,000. Well, 2 red flags go up. Number one, probably withholding.
Yep.
And the second one
New
was
York State.
New York State, because their standard deduction, if it's claimed, the kid is claimed on your on the family's return, the parents' return, they have a very much lower standard deduction. So many times the kids owe money.
Yep, that's right.
So,
and so you got to file. I know I was doing somebody's return last year, and the dependent didn't file for 3 years, and so he brought in the returns, and we got them a couple of $100 back for the dependent, and so it's always a really good idea.
And yesterday I was talking to a client, and they said, they said, oh, we have this simple return, and we were talking, and I said, I said, now you wouldn't be a firefighter, would you? And he says, oh yeah, I am a firefighter, and so is my son. And I said, well, then you guys both get $200.
Yep.
From the state of New York.
That's pretty.
But you got to file to get it.
Right.
Right. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. Wanted to also touch on the tuition and fees deduction. Chris, why don't you explain what that is and who should be interested in that?
Sure. The tuition and fees, like you said, is an adjustment to income. So it's at the bottom of Schedule 1 of the 1040. And what that's for is if you have the lifetime learning credit and you maxed out on it. So maybe your son or daughter is in graduate school and you're in school and you already have your 4-year degree. Well, the lifetime learning caps out at $10,000. So maybe last year you weren't entitled to use your tuition because your kid maxed out that credit. Well, the tuition and fees gives you a way to use your tuition as an adjustment to income, not a credit, but an adjustment to income up to $4,000. So that $4,000, if you're in the 22% bracket, just could have saved you $880
right.
on the federal, not to mention New York State.
And what's cool is it goes back retroactive to 2018. So if that was your situation, you'd get $880 plus interest back on 2018, and you still do a tax return in 2019.
Yep. Correct.
So that's one of the recent changes. Let's see. Oh, okay. The other thing that changes this year, and I know 8030930, 8030930, star 930 on your cell phone. Alimony. If you got divorced in 2019 and you're paying alimony, what happens?
So no longer can you deduct the alimony that you pay as an adjustment to income on your tax return. However, the recipient of the alimony, good news for them, they don't have to declare that alimony as income, which is
except
really good.
On New York State, because the opposite's true, right?
Right. On New York State, you're going to still be able to deduct it if you're the person who's paying it, and if you're the recipient, you have to declare it as income. So it's almost like 2 sets of tax laws.
That is 2 sets of tax laws. Okay, let's go to Jim in West Seneca. Hi, Jim.
Hello there, Esther. How are we doing?
I'm good.
Okay, a question for you. My daughter's employer is offering her a 401k.
Well, that's good.
And they got a 5% match.
Oh.
And she's young, but the problem is they only offer the traditional 401. I asked her to double check for a Roth 401, and they said it's not available.
You don't want the Roth.
Or a convertible or backdoor program where after it's in the 401 traditional, she could then transfer it to a Roth?
But why would you want to, Jim?
Well, because she's young. Her income level right now is still low. And the whole idea is with the Roth, it'll be tax-free.
Okay, so if you've been listening to the show, what's happening is the standard deduction is increasing and increasing and increasing. If somebody's only way of making of a pension is to put money into a 401k plan, they need to have lots and lots of money before, if you think about 40 years down the road when she would retire, 50 years down the road, they would have to have millions of dollars of income in order for them not to be able to utilize this change in the standard deduction and really get most of that money out tax-free. So she'd be giving up the tax benefit now for something that's pie in the sky. That's number one. Number two, do you know what the tax code's going to be like in 40 years?
No, obviously not.
Well, Do you think these are crazy people running this country? I mean, you just don't know. So I've always been of the opinion, maybe I'm wrong, but a bird in a hand is worth two in the bush. And so far, I have seen people that have taken thousands of dollars, tens of thousands, hundreds of thousands of dollars out of their traditional IRA, rolled it over into a Roth, paid all that money up in taxes, and now the standard deduction is so high, they could have taken that out tax-free. Now, I know you're a wonderful, loving dad, and your theory has merit if she's going to make tons of money in the future. But she can always take that money out and roll it over into a Roth later on as she goes on. But right now, I would, and maybe she doesn't even need the tax write-off right now. How much is she making?
She's only making $40 a year.
Yeah, well, see, she's gonna get a tax break. Well, anyway, it's up to you. But I will tell you that I would let her build it up under the taxable 401k. She can always roll it over to a Roth and make it
Is she working?
Chris has told me there is a backdoor way.
There is, but
you roll it over.
Well, no, there's enough. Yeah, but is she working for the county, the city, or the state?
No, private.
Okay, then I would not do a Roth. If she had a government job, then I would look into Roths because she has a guaranteed pension. But right now, her only retirement is going to be her.
The reason it's a backdoor is because she's taking it and rolling it over. Right. And she can do that, and then she'd pay the taxes on it. But I would not. She can always pay the taxes.
All right.
I'd build it up first.
Very good. Thank you.
All right. Thanks, Jim. Bye-bye. I know many financial people would say, no, don't do it that way. But I have seen tax law change, and people that have paid taxes on their Roths from a traditional Roth are very sad now. So that's because you don't know. I'm Esther Galius, the tax lady, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break, and we'll be back with your calls on the other side. Hey, we are family. I'm Esther Golias, the tax lady from EG Tax, where all 33 of our offices are open in Western New York and Florida and Arizona. And I will tell you, if you have tax questions and our staff is too busy to answer them on the phone because we have to make money to stay open, you can always go to our website and email me, and I will email you back. Okay, and many times I'll call you. So if you need help and somebody is too busy to answer the question over the phone, just email me and I will email you back.
You've been at restaurants and I'll go bring and you'll answer it. You'll
it.
Be
in the middle of the night. I will answer it and I will email you back. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone. You can text us at 3930, and we are going to Mike in South Buffalo. Hi, Mike.
Hi.
What can we help you with?
I got just a stupid question.
No such thing as a stupid question.
Last October of 19, I bought a house for my two daughters.
Okay.
Just to try to help them out.
Right.
Even though they pay me, I like to call it the mortgage because that's all I make on them is enough to pay the mortgage and the user fee here in the city. Do I have to claim that as income?
Okay. See, when you're renting it below fair market value, and so this is the red flag. When you're collecting income from a family member and you're renting it below fair market value, what happens is the income becomes taxable, and basically you can't deduct any of the expenses anymore. There's not even a vehicle to do that. If you really love your kids, you're going to charge them fair market value because they love their daddy and you were so good to them. So let's say that the house next door, the rent that they're getting is $1,500 a month, and you've been charging your daughters $1,200 a month. Have them give you $1,500 a month. You claim the income, then you can take all the expenses, the mortgage interest, the property taxes, the repairs, the insurance, everything to operate that house, the mileage to go pick up the rents, depreciation. It will help your tax return. And then, you know what? You can always give your daughters a gift. and the gift is tax-free. But you need to have a profit motive in order to take those expenses, or else you're going to shoot yourself in the
Yeah,
foot.
and what Esther means, shooting yourself in the foot, if they don't charge you fair market rent, it has to go on other income, because that's where a non-for-profit rental goes. So you'd have to put it on line 21, which is other income, which would shoot you in the foot.
Really bad. It would be a terrible thing. So what I always say to somebody is, let's say your kids are giving you an extra $4,000 rent. There's nothing that stops you. You can give your kids gifts all the time, which would be tax free as long as they're under $14,000 a year. So you can. Is $15,000 now? Okay, thank you. So you can always give your kids a gift back, but the income that you get has to be for profit in order to take the expenses on that house. So make sure you do that.
Okay, so by doing this, I probably made a major mistake then.
Yeah.
Well, but one thing about mistakes, you can correct them.
Yeah, and Esther gave you a really cool thing: is charge them fair market rent, but then on the other hand, give them a gift back.
Right. And that's fine.
You can't afford the fair market rent. You know.
No. But see, Mike, have them give you write a check for the rents. All right. And if it should be $1,500, that's what they give you. You can give them a gift back.
Okay, I gotcha.
You with me?
I 100%.
So on the right-hand side, you're getting fair market rents. On the left-hand side, Daddy's helping his kids in their living. The income, it makes it fully deductible. Then the property taxes are deductible. The user fees are deductible. The insurance is deductible. Travel to go take care of it's deductible.
Depreciation.
All the repairs, the depreciation are all deductible, but not unless you're getting fair market value.
Excellent. I appreciate the advice and the help.
All right. Thanks, Mike.
Really good
Bye-bye.
question.
It is
Better
a good question.
to
And
ask
I will
now.
tell you, in Buffalo, there's so many rentals.
Mm-hmm.
And a lot of times people say, oh, I got my kids living upstairs. Oh, my aunt's living upstairs. And so what they're doing is they end up, you got to tax them on the income because there's no profit motive.
Right.
Remember, the IRS is not going to let you take the expenses unless you have a profit motive. So once you put family members in there, it's got to be fair market value.
Yep, absolutely.
All right?
Yep.
All right, let's go. Again, 8030930, 8030930, star 9 on your cell phone. We got a text.
Yeah,
Yes.
it says if she there might have not been another part to this. Can you scroll
No,
down?
it's up.
If she wants to do a Roth so bad, why not just do the minimum for the traditional match and then contribute to a Roth IRA? Her low income qualifies for a 6K Roth IRA in addition to the 401K.
That's true. There's all kinds of, I mean, the truth is there's so much you can do. Unfortunately, people don't even avail themselves of what's available.
Mm-hmm.
So that's a great comment. That's a great comment.
Again, you're playing the game that you're going to have higher tax brackets when you retire, and 90% of people
I mean,
don't.
let's face it, in 20 years or 10 years or in 2 years, if there's the wrong thing that happens, we could eliminate income tax. They might go to a sales tax. Then what's going to happen? All you
tax,
people with
yeah.
their Roths. I mean, believe me, from what I can see in our government, anything is possible. They might go to a socialized system and all the money's there and they give you something back. You don't know. We don't know. We don't know. Okay, let's go to Dave in Lockport. Hey, Dave.
Hi, Esther.
Hi.
I took a distribution from a traditional IRA.
Okay.
A small distribution. I'm 65, and I determined that my income would be about $50,000.
From what sources? From Social Security?
From a pension and investments.
Okay.
And determined that I would be about $1,000 under the change in the marginal rate from 12% to 22%.
Okay.
Does that make sense?
So you're trying to avoid paying 22%.
Right.
Okay. Well,
Do that for
it sort of makes sense, but what I'm going to tell you is where a lot of people get confused with tax rates. So if you are over by $500 in the 22% bracket, only that $500 gets taxed at that 22%.
Yeah, it's a graduated tax rate.
Right.
Right.
So that $1,000 you're going to pay $220 on. versus $100. So the whole thing costs you $120
It's
extra.
not like all your income slops into that tax bracket.
But,
Only the amount
but Dave,
that
you're
lives
not
there.
working, right?
Right, I'm not working.
All right. I was going to say if you were, then you could have put money into an IRA to eliminate that. But it's only going to cost you an extra $120 over what it would have been. 10% times 1,000, because you said you're over by 1,000, right?
Yeah, well,
He's trying to keep it 1,000 under so he doesn't hit that bracket.
Okay.
so I'd be saving $100 a year if I did it until I got to my required minimum.
Right.
Yep.
contribution.
Right. Which is not the end of the world.
Right.
It's one good dinner out at Russell's, if that. Okay?
I have a related question.
Yeah.
The same thing with that, with converting a traditional to a Roth IRA.
Okay.
That same kind of strategy can you convert a Roth when you're not working?
Of course, yeah. You sure can.
And if I can only convert $2,000 or $3,000 per year under that same idea, does that make any sense?
It may. Are you on a pension plan? Your pension plan must be pretty robust, right?
Yeah.
Yeah. So obviously, anything that you can keep at that lower tax bracket is good, except that you might say, well, I think I'll just wait till 72 and, and just do the RMD when they come up. But obviously, whatever you can get out at the 10% bracket would probably be a lot better than doing it at 22%.
Right. Okay, good.
Okay. Hey, thanks for calling, Dave.
Okay.
All right. I'm Esther Gulius, the tax lady from EG Tax. If you need tax help, we want to help you. We are your friends. We're your family. Give us a call at our corporate office at 632-7886. You can go online to egtax.com. Until next week, I'm Esther Gulius, the tax lady, with Tiffany Fabian, Christopher Fabian. Stay warm on Sunday, and if you need any help, you can always go online, and I will answer your tax questions. Have a great week. God bless you guys. Bye-bye.